On September 12, 2019, SmileDirectClub went public at a $1.3 billion valuation, promising to democratize orthodontics by shipping plastic aligners directly to customers' doors. No dentist visits required. The pitch was simple. Cut out the middleman, slash costs from $5,000 to $150, and trust algorithms to straighten your smile. Within 4 years, the stock would crash from 23 to 8 cents. The American Association of Orthodontists declared the model dangerous. Dentists flooded state boards with malpractice complaints. Over 1,500 lawsuits piled up documenting cracked teeth, exposed roots, and bite damage requiring jaw surgery. By September 2023, SmileDirectClub filed for bankruptcy, abandoning 900,000 patients mid-treatment. This is the story of how a company bet $9 billion that Americans would trust their smiles to mail-order plastic, with no safety net if the teeth moved wrong. The promise seemed irresistible when SmileDirectClub launched in 2014. Orthodontics had been expensive and inconvenient for decades. Metal braces, monthly adjustments, years of treatment. Co-founders Alex Fenkel and Jordan Katzman built a different model. Customers took impressions at home or visited mall kiosks for 3D scans. Software designed their treatment plan, and aligners arrived by mail. Remote dentists reviewed cases. No office visits. No orthodontist supervision. The price dropped to $1,850, paid in installments. Growth exploded. By 2018, SmileDirectClub had treated over 500,000 customers and generated $423 million in revenue. Venture capital poured in, $380 million from firms like Kleiner Perkins betting on dental disruption. Social media testimonials went viral. Influencers promoted before and after photos. Mall kiosks opened across America. The tension was planted from the beginning. Speed and convenience versus medical supervision. Most customers didn't notice. The backlash started quietly in 2017, then escalated fast. State dental boards in Georgia and Alabama launched investigations into unlicensed dental practice. The American Dental Association launched its Oversee, Don't Overlook campaign, targeting direct-to-consumer aligners as potentially dangerous. The contrast with established competitors became stark. Invisalign, the industry leader, required in-person orthodontist visits throughout treatment. Orthodontists could monitor progress, adjust timelines, and intervene if complications arose. SmileDirectClub's model eliminated that safety net entirely. The company fought back aggressively, hiring remote dentists to review cases and arguing it was a platform, not a healthcare provider. It sued dental boards for anti-competitive behavior, framing resistance as protectionism. Press coverage split cleanly. Tech media celebrated disruption. Dental journals raised safety alarms. Customer complaints surfaced on Reddit. Threads documenting bite problems, receding gums, teeth shifting in wrong directions. The company's response was consistent. Adverse events were a small percentage, normal in any orthodontic treatment. But a deeper problem was emerging that wouldn't surface for years. SmileDirectClub had no systematic way to track outcomes after aligners shipped. When SmileDirectClub went public in September 2019, the prospectus told two conflicting stories. Revenue had surged 113% year over year. The company pitched investors on massive total addressable market, capital-light operations, and tech-enabled efficiency at scale. But buried in the S-1 filing was a warning. We may face increased regulatory scrutiny. The burn rate was staggering, 75 million lost per quarter. The unit economics raised questions. Customer acquisition costs were approaching lifetime value, meaning each new customer barely paid for the marketing required to find them. The growth strategy revealed its own trap. SmileDirectClub had to spend aggressively on marketing to acquire customers faster than bad reviews could spread. Management argued scale would eventually deliver profitability once the brand was established and marketing efficiency improved. Wall Street bought the story initially. Within months, reality would intrude. California's dental board ordered case-by-case review requirements. Multiple lawsuits from customers alleging permanent damage began working through courts. In January 2020, NBC News aired an investigation titled, "Is SmileDirectClub's Teeth Straightening Safe?" featuring patients with severe complications. The company spent millions on lobbying and legal fees. Regulatory and legal costs ballooned to 15% of revenue. Competitors like Byte and Candid faced similar scrutiny but chose a quieter approach, avoiding public battles with dental boards. SmileDirectClub doubled down, framing dental opposition as anti-competitive rather than safety-focused. The stock, which had opened at $23, was trading around $6. Then the pandemic hit. In March 2020, COVID-19 shut down SmileDirectClub's mall kiosks, its primary customer acquisition channel. The stock plunged to $3. The company attempted an ironic pivot, selling through dentist offices, the very professionals it had tried to eliminate. Second quarter revenue dropped 27%. The company laid off 800 employees. Treatment complications spiked as customers got stuck mid-treatment, unable to access in-person help during lockdowns. Reddit and social media flooded with abandonment stories. Aligners arriving with no guidance, treatment plans going off track. No one available to adjust course. The company extended its Smile Guide remote support. But the pandemic exposed the model's fundamental weakness. When patients needed emergency intervention, there was no one to intervene. Remote dentists reviewing cases on screens couldn't physically examine a patient whose teeth were shifting dangerously. The efficiency that made the service cheap made it incapable of handling complications. Between 2020 and 2021, the evidence became overwhelming. Lawsuit counts passed 1,500 individual cases. Court filings documented specific harms: irreversible bone loss, exposed tooth roots, bite misalignment requiring corrective jaw surgery. Key testimony emerged from a former treating dentist who revealed reviewing over 20 cases per hour, roughly 3 minutes per patient. An NBC follow-up investigation found patients told that aligners would fix problems actually requiring oral surgery. The American Journal of Orthodontics published case studies of SmileDirectClub patients needing extensive corrective treatment from actual orthodontists. The company maintained its defense. The same complications occur with traditional braces. But the critical difference became impossible to ignore. Traditional orthodontists could intervene immediately, adjusting treatment in real time when problems emerged. SmileDirectClub's remote model couldn't. The business model tension crystallized into a simple reality. The efficiency that made it cheap made it dangerous. Insurance companies began denying coverage for corrective work after SmileDirectClub treatment, arguing the original treatment was elective and improperly supervised. The stock hovered between $2 and $3 as litigation reserves accumulated on the balance sheet. In 2021, SmileDirectClub attempted a rebound through aggressive marketing. Celebrity partnerships with Draymond Green and influencer Bart Baker aimed to rebuild trust. By third quarter, marketing expenses hit 40% of revenue, an unsustainable ratio. Customer acquisition costs climbed above $800, while lifetime value shrank as negative reviews proliferated and completion rates dropped. Competitors were adapting. Byte pivoted toward dentist partnerships. Candid emphasized professional supervision in its marketing. SmileDirectClub went the opposite direction, doubling down on direct-to-consumer purity and framing it as a consumer choice issue. Wall Street analysts downgraded the stock, citing unsustainable unit economics. Fourth quarter 2021 marked the inflection point. Revenue declined for the first time, dropping to $126 million from $184 million the year prior. The stock traded at $150. By April, the company shut down manufacturing facilities and outsourced production. In August, it closed 63 retail locations. In September, NASDAQ delisted the stock. It was too cheap to meet listing requirements. Each cost-cutting measure aimed at profitability simultaneously reduced the company's ability to serve customers safely. Early 2023 brought the endgame. The stock traded at $0.20, Revenue collapsed 40% year over year to $370 million. The company couldn't raise new capital. Potential investors saw a business model tainted by lawsuits. On September 30th, 2023, SmileDirectClub filed Chapter 11 bankruptcy. Assets totaled $293 million. Liabilities reached $911 million. The immediate impact landed on customers. 900,000 patients were in active treatment when the bankruptcy filing hit. Press coverage captured the final irony. The assets sold to a parent company for $63 million below the IPO valuation 4 years earlier. SmileDirectClub confused product innovation with business model innovation. A fatal distinction. Invisalign succeeded by partnering with orthodontists, enhancing their practices with better technology. SmileDirectClub tried to eliminate orthodontists entirely, creating both medical risk and a powerful regulatory enemy. The historical parallel runs to Theranos, which promised to disrupt lab testing by eliminating trained technicians. Biology didn't cooperate there either. The contrast with successful direct-to-consumer brands highlights the mistake. Warby Parker disrupted eyewear retail, not optometry. Casper disrupted mattress retail, not sleep medicine. SmileDirectClub chose the one healthcare vertical where unsupervised treatment could cause permanent physical harm. In software, bad products can be fixed with updates. Teeth don't reset after a bad review. Marketing could paper over product flaws in digital services. The company faced 3 simultaneous failures. Medical complications mounted, regulatory investigations intensified, and the economics never worked. The final accounting tells the story in numbers that can't be argued away. Value destruction. $1.3 billion to $63 million in 48 months. Customers today are seeking corrective treatment. Many unable to afford the orthodontists needed to fix damage from cut-rate aligners. Class action settlements remain pending, but the company is bankrupt and victims are unlikely to recover their costs. The regulatory impact spread across states. 15 jurisdictions passed laws requiring in-person orthodontic supervision for aligner treatment. Venture capital funding for unbundled healthcare models dried up industry-wide. The competitors who survived were those who emphasized supervision rather than replacement of dentists. You can't unmove teeth. Permanent physical consequences outlast business models. The final count. 1,500+ lawsuits. 900,000 patients abandoned mid-treatment. $9 billion in investor value destroyed. SmileDirectClub reached bankruptcy before regulators could shut it down. The market delivered the verdict first. Disruption works brilliantly until biology reminds you that some systems evolved safeguards for reasons you can't algorithm away.